Property prices remain in freefall, with this downturn now ranking as the deepest on record. And with another interest rate rise on the horizon, it raises the question, how much further are prices likely to fall? Finance reporter Chris Kohler.
The last 3 years has been the wild.
Hello everyone, this is Miko Santos and welcome to Red Wires from the Newswire. And today's episode will talking about the property market right now is a little bit, because of the interest rate, potentially another hike for interest rate. So there is property is going down, but there also a rent crisis as well for many Australian. And for today's episode, we're talking to one of the experts, Associate Professor Konark Saxena. He is from School of Banking and Finance at University of New South Wales Business School to discuss to us about this, what's happening right now in the property market. And please welcome to the show, Professor Konark.
Thank you for having me, Miko.
So first question I have for you, property market in Sydney and Melbourne, mostly in Australia, is falling down. The price is falling down. But however, the interest rate is potentially getting higher as well. Can you tell us the background and what's going to be the effect of this to many Australians?
Sure. So I'd say there are two important parts to the background here. One is how interest rates affect the property market and housing values, and two, sort of a few thoughts on why interest rates are rising in the first place and what it means for the future. So on property values and interest rates, it's a relatively simple relationship. Property is a stable asset in terms of fundamentals. Its value is relatively stable, and it's a long-term asset, right? Especially the underlying land value. So over time, it has a lot of value. And people borrow from banks at a particular interest rate to buy it. So when interest rates rise, their cost of borrowing increases, and so that makes it more difficult to buy, and so the value would be a bit lower. It's also a bit about opportunity cost of capital. Like if you're just an investor and you're looking at a real estate or interest rates as two different assets to invest in, or a saver, when interest rates go up, they become more attractive. And so if you're investing in a portfolio of real estate, you'll take some of the money out of real estate and put it into a savings account. So that opportunity cost of capital is the second mechanism where the property values come down as interest rates go up.
How does the raise of interest rate affect the many homeowners?
So homeowners who have mortgages and those who don't have mortgages, there's sort of two different effects. So those who have mortgages, the most important one would be that they have to pay higher interest rate payments, right? And hopefully many of them can afford it, even with a 3% increase. But there'll be a few that were just about affording their mortgage, and they might be in distress and not be able to pay those mortgages. And so that would cause financial distress, and there'll be sort of a lot of consequences around that. And even for those who don't have mortgages, there is what's called the wealth effect, which means that the value of, their wealth will go down as property prices fall. And that means they can consume less and they'll spend less. And that also affects the economy. And of course, it affects them and their plans for retirement.
So next question I have for you is that how interest rate affect the market? So right now there are a lot of issues, especially the rent crisis right now is set to spread this year. How does gonna be affect?
Rents, I think, are affected from a few things. One of them is just inflation. So because inflation is really high right now, and those who own properties would would like higher rent on them, so they'll be asking for more rent. Otherwise, it might not be worth renting it out. Then also when for example you're paying higher interest rates on your mortgages, and there's a bit of a pass-through effect, which is like to the extent possible, they might be inclined to ask for an increase in rent if they can. And so that sort of change in the supply would also increase the price of renting. And I think there's another mechanism about supply related to how just the negative gearing and tax structure might be incentivizing some households, given their financial circumstances, to just keep their flats empty, for example. And so that could be reducing supply and causing a impact on rent as well.
So a lot of people are, many Australians are bracing about the upcoming more cash rate gonna be up by RBA this year. And if the cash rate is gonna be up, which means the interest rate will be going up as well. And what do you think is the option for many homeowners? Because once the cash rate is up, interest rate is up for the home loan, because bank will hand over to the customer because of because of the cash rate.
Look, I, I don't want to give any financial advice per se. It depends on the particular circumstances of the household. Uh, but broadly, there are few options. If the interest rate goes up, you just pay the higher mortgage, right? If you can afford it, and if you want to keep the house. Some households who have already seen capital appreciation on their house can ask the bank for a higher loan, and then use that to pay off some of the interest, or rather push it out. And the third is to sell. Like if they can't afford the house, it's okay to sell the house. It's in a circumstance which you might, if you're not able to predict the future of the housing market, which is looking quite uncertain right now, uh, and you're near financial distress, maybe it's okay to sell. But as I said, I don't want to give financial advice, so I think they should be talking to their financial advisors on this one.
Thank you for that, Professor. So I just want to go deep into this market right now. That why is the houses going down, falling down the prices, while the interest rate is going up? How that can be correlate?
Okay, so that's related to a question I answered earlier, which is a higher interest rate means a higher opportunity cost of capital for housing. So you take money out and put it into the risk-free rate, or bonds, and then higher mortgage prices might mean that there are some households that are just selling. So there's a bit of selling pressure that push down the property prices as well. Um, and that's really, it's a common financial, it's true for a bond as well. So if you buy a 30-year bond and the short term interest rate changes, so if the interest rate goes up, the value of the bond goes down, and the interest rate goes down, the value of the bond goes up. And so housing prices behave a lot like these bonds, long term bonds. um, and so one reason house prices have increased over the past 30 years is simply the 30 years the interest rates have been largely declining, and bonds have been increasing along with house prices. And now when interest rates are going up, again the mechanical relationship to some extent, we expect house prices to go down. And I think some households don't realize that. They just look at the past 30 years and think house prices have only gone up, so I'll just keep buying. But it's important to note the future projection of interest rates is very important in adapting how the property market's going to go.
Thank you for that. Last question before we wrap up the podcast, Professor Konark, is what in store to us in 2023?
I think it's going to be a very interesting year on different fronts, especially in the property market. I think in inflation would be still an important story in 2023. Um, and I do expect some inflation surprises on the upside later in the year. Um, so you see inflation in Australia going up while in the US coming down a bit. And I attribute that partly to higher increases in interest rates in the US compared to in Australia. So the consequences of that would play out. But of course, the advantage of not having increased interest rates was that we have less distress at the moment. I think consumption over December, January has been relatively good, right? So there are advantages of not going too fast. The second thing I look out for is the end of the fixed rate period for mortgages. Many households got fixed rate mortgages, which is ending in this year, and so that's a critical time to see how the market behaves. Are there enough buyers out there, first home buyers or other buyers, to buy when some of the households who are not able to refinance their mortgages at a attractive rate decide to sell? There will be a few, and how many of these are there is another sort of question to look out for. So those two are important things, and then there are international forces which could affect the currency. So I am cautious about the Australian dollar right now. I would think it can fall this year just because the interest rate differential between the US and Australia has increased. So I don't, as you can see, I don't have the most positive outlook, but I think assessing the risks in front of us is probably a good thing.
Thank you so much, Associate Professor Konark Saxena, School of Banking and Finance at University of New South Wales Business School. Thank you so much.
Thank you so much for having me.
That's another episode from the Newswire from redwires.au, and this is Miko Santos. Thank you.